Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome to another episode of Markets, Mystics and Mayhem. The last week has been madness. It really has. We have a lot of mayhem in markets. Liberation Day in the United States, Trump tariffs coming through a lot stronger, a lot harder, a lot heavier than analysts expecting. Equity markets don't like it. They've fallen quite sharply, particularly stocks that are either importers or exporters. Interest rates have been slashed on expectations of weaker growth, and currencies are reacting quite violently to the moves, particularly commodity currencies or risk-on currencies like the Kiwi, which has been slapped. To get into it, we have invited a special guest. So Sabrina and I are joined by Kiwibank's Treasurer, Belinda Newman. Thank you very much for joining us. In terms of, jobs within a bank, I think, obviously economists are the top. The bank would fall apart without economists. It would collapse tomorrow. But I think, the treasurer of a bank, I think, is probably the most important role we've got. So thank you very much for joining us. We're going to get straight into it. I'm not mucking around. There's so much to cover. Trump, Liberation Day. What happens?
Yeah, it's been an interesting ride, really. We saw the initial headlines come out last week on Thursday at 9 a.m. and I think initially the market didn't really know how to take it. But pretty quickly, as the market digested the news and, I guess initial reactions started to come through from economists and market strategists out there, we realised, it was probably, a lot more dovish from a growth perspective than what we were expecting. A lot more heavy-handed from Trump. He really means business here.
Yeah, he does. We all know there's going to be negotiations and a lot of these rates will be lowered, but they're being lowered off a much higher level, right? Just a lot higher level. What happened? What were the tariffs?
Yeah, well, there was a lot of them. At least 90 countries face tariffs above that 10% minimum baseline. New Zealand, we were pretty lucky to just get away with that 10%, same with Aussie. But then you look over to countries, Asian countries, China was hit with another 34%, and that's on top of the 20% they already had pre-Liberation Day. Then you look over to Cambodia, what was the other country? Vietnam, they were hit pretty heavy, also around 50%. So some pretty heavy tariffs there. There is a bit of confusion as to exactly how this turns out to be a reciprocal tariff. According to Trump, it's what they do to us, we do to them. And that is what you'd expect for a reciprocal tariff. But looking at how they've sort of been calculated, it seems like maybe his take on reciprocal tariffs is what's the trade balance between a country and the US and sort of taking the half of that.
Yeah. There's thoughts about, any country that's running a surplus against the United States, we need to punish them. It's almost like Trump wants to go back to the early 1800s with the amount of tariffs out there and the percentage of government revenue, which is very negligible at the moment, to being something quite substantial. So there's a revenue grab there. And I think there's a lot of discussion around just trying to rebalance the United States, trying to protect certain industries, trying to get cars manufacturing back up and running, all that sort of stuff. But geez, it just markets markets don't like it.
Absolutely, yeah. Equity markets, have really taken a hit, globally, really. From Thursday night onwards, and you're really seeing a flight to quality, in terms of government bonds, yields substantially lower. Commodity currencies are in the spotlight. So they're obviously under some pressure, even the likes of gold and oil with the reactions that you're seeing from WTI.
Yeah. So, like you say, the flight to safety, right? We talk about this a lot in markets, the risk off trade.
Yeah.
You pile into bonds because they rally as interest rates fall. Some people pile into the likes of gold. You go into those more defensive stocks at a minimum, and you look for the currency that you think is going to perform the most. And it's interesting, the US dollar was kind of bouncing all over the place, but still retains that flight to safety bid.
Yeah, absolutely. It's interesting. Obviously, I think the 10% tariff for New Zealand is obviously not directly, too severe from our economy's perspective in relation to the trade that we're doing with the US. But if you look at the extent to which we've been impacted, it's more through, economists' expectations of how it's going to impact the growth of our, trade partners, the likes of Australia and China in particular. Coming under some very heavy scrutiny, and, their currencies obviously, well, Australia in particular, obviously under pressure. That's really playing out, I think, in terms of New Zealand interest rates and the currency as well.
Yeah. Well, our two largest trading partners are really head to head right now. We've already seen China retaliate as well, implementing an actual reciprocal 34% tariff rate back on US imports. And, now we're going to see, does the US counter react? And really all of that, back and forth, and really the closure of, moving away from this globalisation. It's just never really good for any trade, global trade. And, if we look at where we've seen some very small green shoots of recovery for the domestic economy, it has really been concentrated in that external export sector. So, it's not a good outlook for the New Zealand economy's growth from here. And I think, markets are definitely starting to realise that, even though we flagged it if you go back and probably watch the past 3 or 4 episodes, I think we've always had a little segment saying, hey, the risks are to the downside. Now we're here, and we're seeing markets are pricing that in, right, Jarrod?
Yeah. I just want to highlight that there are commentators out there, even today, that are saying, this is an inflation risk. Central banks shouldn't be cutting, if anything, that might cause a hike. I just think that's completely and utterly wrong. They've missed the fact that what you've both said is there's downside risk to growth, and that dominates, right? So any spike in inflation that we're likely to see near term as the tariffs come on, it's where's inflation going to be in a year's time, 2 years' time with weaker growth? It's going to be lower. The downside risks are dominating, and it's playing out in financial markets. And RBNZ pricing's moved, right?
Yeah, that's right. I think growth in particular, like for the retail sector, what we've seen in terms of our mortgage flow is borrowers have been fixing quite short. So they should be, all else equal, relatively well positioned, if we do see lower rates play out. But I guess how this plays into investment intentions and decisions of businesses, just with the additional uncertainty now, you're already seeing them struggling to bounce back, post the recession. And I guess this just adds another element of uncertainty. So it's probably not particularly helpful for credit growth on the business side.
No, you're right. And, when we're talking to our customers, that's what we're hearing, right? There's been a lift in confidence as rates have been cut in New Zealand, which is nice, but it hasn't fed through into activity yet. And it definitely hasn't fed through into investment intentions and hiring intentions. Like, you'll talk to a business owner and say, hey, how are things going? Oh, things are looking better. You go, right, well, are you hiring? No, we're still restructuring. We're still, cutting hours. Are you investing? Like, don't be silly. It's not even on the table at the moment.
Yeah. So back to your question around market pricing, expectations for the OCR in New Zealand. I think initially, because we've been hovering around that OCR end point of, 310, 325 for quite some time. Initially, we saw that kind of move down to 3%. And, that has kind of continued over the last, say, 24 hours of trading, where now you're kind of seeing the potential for a 275 endpoint being priced. That's certainly what the market's looking at right now. I mean, there's obviously more to come. And I think the longer you're seeing retaliation from some countries and you're seeing some countries try and come to the negotiating table, this is going to very much be resolved on a bilateral basis. But the longer you've got uncertainty around our larger trading partners, I guess the more risk that persists. And probably, it's an interesting week, obviously, with the OCR decision this week, but something that the Reserve Bank will have to think about in terms of that endpoint. Perhaps not for this week because it's an OCR, but certainly by the time that we come around to the next MPS.
Yeah, at their full statement where they update their forecast. Yeah, I think they'll have to include the downside risks of growth. You can't avoid it really.
Yeah, and I think it's crazy. This morning we were writing our weekly and I felt like we were writing something and then 5 minutes later we had to keep changing it because the market was moving so fast, which to me is super exciting. But really, like, focusing on market pricing has gone from, basically pricing in maybe a 3% terminal rate. We've now seen it move to around maybe a terminal of like 265. So that's essentially saying they're pricing another full 25 basis points below 3% to 275 and then odds on for another cut to 2.5.
Yeah, big move, right? And that's just in a few days.
Yeah.
We get these moves every now and then. But, you look at what's happened in equity markets, I don't think we've seen a drop like that since GFC, maybe in COVID, but definitely the GFC. And then you've got to look right back to 1987. Was it Black Monday? These moves are huge. And then the move in rates.
Yeah, the 2-year.
Big. Yeah. We saw a similar move midway through last year, didn't we? But this one's been quite big as well.
Well, yeah, that's right.
A couple of weeks ago, we were saying, the 2-year, it's stuck trading in its sort of range of 340, 360. Come this morning, we're at sub 310. Potentially going lower or staying around there.
Yeah. Well, expectations have just shifted, right? The game's changed. Whatever we thought global growth was going to be, you need to shave off, 1-2 percentage points. That's massive. That's massive, and it'll feed through on our exports and export prices. The weaker Kiwi helps, but it's just this growth story.
Particularly for a small open economy such as ourselves.
Exactly, at the edge of the earth, and so heavily reliant on our export sector, right? So, what do you think financial markets will do from here? How do you, I know you're obviously trading rates and everything quite regularly. How do you think through something as violent as this?
Yeah, I mean, I should explain one of the roles of a bank's treasury function is to ensure the bank's, position for to protect the income of the bank against moves in interest rates. So when Jarrod talks about trading interest rates, we're essentially managing the risk of, predominantly our term products, term deposits and the fixed rate lending that we do. I mean, certainly from my perspective, if you look at the moves that we've seen over the last, say, 48, 72 hours of trading, I think there has been certainly an element of illiquidity coming into play. Yeah. So we do need to give the market some time. There's been a lot of panic around, certainly amongst the, say, fund management community where they're seeing big valuation changes on their equities portfolios. That's causing, potentially reactionary transactions in their fixed income portfolios as well. So we do need to see how all of this plays out. And we will also need to hear from the Reserve Bank in terms of how this changes their assessment of the New Zealand economy and, monetary policy settings. But, I mean, it's difficult not to be positioned for lower rates in this environment. Certainly we've got a yield curve that's still got some degree of steepness into it. If you look out, say, past 2 years. So, is this a paradigm shift? Does this result in a lower, say, neutral OCR, over the, near to medium term than it would otherwise do? And how's that going to play out in terms of our wholesale curve? we're yet to see that. But yeah, that's kind of what I'm thinking about anyway in terms of the risks.
Yeah, I completely agree. It's really easy to think of levels and then get them stuck in your head, like the 3% terminal rate for the cash rate. People are like, oh, I can't go much below that. Well, it can. They cut to just a 0.25% during COVID. So there's a lot that the cash rate can move, and all central bankers will just cut and cut if growth surprises substantially to the downside.
Yeah, they're going to do what they need to do, right? There's no limit on it.
Yeah, exactly. One central banker once told me that we would just keep throwing water at it, and that was during the GFC. It was like we just keep throwing water until the fire's put out.
Although I do think maybe there's been some lessons learnt through COVID, in terms of, you can go too far and for too long.
That's right. But the initial reaction, I think, to COVID was bang on, but it was the more fact that they went for too long, too far, like you say, and we learnt from that. So I think, if I was thinking about what's going to happen in markets, I think it's central banks, again, that will put the floor in the markets. It'll be them coming to the rescue, potentially, and that's just like it was in COVID, just as like it was in other episodes. When they're coming on strong like that, that's when the markets start to turn. But I think we're a little way away from that. I think that this can continue for a while. Actually, this violent moves, because like you said, this week's decision from the Reserve Bank is pretty much a stepping stone, right, between monetary statements. So we're not really going to get a lot out of the RBNZ until May. And that's when we'll know, are they cutting to 3 or are they cutting to 2.5 somewhere else?
Yeah. And I think they, in fairness to them as well, they do need that time to, I guess, digest the headlines and the response in terms of respective countries.
Yeah, absolutely.
Okay, Belinda, so I know you already covered a little bit about what a treasurer does on the interest rate exposure on the balance sheet, but it's a big role. What else do you cover?
Yeah, I mean, we look at the risks, the financial risks in the balance sheet. So in addition to interest rates, to put it simply, we make sure that we have enough cash in our bank account with the Reserve Bank and to be able to fulfill all the bank's obligations. And that's not just today and tomorrow, but it's thinking about the funding position of the bank over the more medium to longer term, how we're going to fund the growth in the balance sheet, through what markets. In addition to deposits, we raise funding in wholesale funding markets. So, I guess we're constantly monitoring markets, constantly, making decisions around the path to growth and what the best source of funding for us is. And we're also thinking about the credit conditions and, the extent to which we think the balance sheet's going to grow on both sides over the next period of time.
So for me, banks obviously play an outsized role in the economy, and credit is very much the oil within the economic engine. I think part of the slowdown, part of the recession over the last couple of years has been the fact that credit has tightened up. Banks haven't been, as open, or their risk appetite hasn't been as great the last couple of years. What are we seeing right now? Is that getting worse? Is it getting better?
Yeah, I think in fairness, over the last couple of years, it's quite different to normal conditions. Post-COVID, what you saw was a need for, a lot of businesses' balance sheets to repair. They took on a lot of debt through COVID, whether it was through, the business guarantee scheme that the government came out with, or the IRD loan scheme. So there was a reasonable amount of additional debt that built up through COVID on businesses' balance sheets. And so I think you've really gone through that period of repair, and we were just kind of reaching that point where, you did see an environment where actually businesses were starting to get on top of that, and I think come out of that on the other side and think about, investment decisions and starting to spend. So there's probably, the latest round of tariffs and, all the volatility now just creates more uncertainty, I think. So, not particularly helpful right here and now.
Yeah, Yeah, no, it's not right. That uncertainty sort of kills growth, right? Kills investment intention. So yeah, that's something we're just going to have to watch carefully.
Yeah, absolutely. All the sentiment measures, but I think business in particular.
Yeah, absolutely. New Zealand is a nation of small to medium businesses, right? And we need them bouncing back. And part of that is the property market as well. But yeah.
Yeah. So I think to the extent that banks are certainly ready and available and willing to lend, then, I think we've got to have, businesses that are, got a good structure in terms of their underlying business and, a good balance sheet. That can kind of support that lending and good opportunities in terms of business opportunities to lend to. So
yeah, I mean, being an economist, there's the supply of credit, which is the bank's appetite, and then there's the demand for credit, which is the business appetite, and it's kind of gone like this over the last few years. Banks, I think, are coming back a little bit. Well, at least prior to Liberation Day, but the businesses haven't yet sort of taken on the debt.
That's right. But we hope to continue to play an outsized role in funding that growth. So.
Oh, we will.
Yeah.
Absolutely.
Well, I think that's probably all we have time for this week. Definitely a very volatile, interesting, and exciting time. I know I'm saying exciting when it's kind of like everything's blowing up. But for an economist, this is fun. I think don't laugh.
Well, that's good.
Okay, well, I think, we haven't seen the end of things yet. Trump's tariffs have only just been put through and we're only just starting to see the retaliation come through. We could definitely see more on that front, which, could put more downside pressure on equities, on, commodity currencies and also on interest rates. So, stay tuned because we'll be covering this more as it develops. But as usual, make sure to follow, like, and subscribe.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.